Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. Now, since Trump's inauguration back in January, there has been a flurry of announcements and tariffs with other countries scrambling to respond. I mean, we're seeing the announcements sending shockwaves globally, hitting dozens of economies, representing the biggest disruption to global trade in decades. And here in Singapore, we're no exception. During a parliamentary speech on April 8th, Prime Minister Lawrence Wong announced that the recent tariffs imposed by the United States will hurt the Singapore economy, businesses and workers. So top that off with the Ministry of Trade and Industry announcing a cut to Singapore's growth forecast for this year to 0% to 2% in the face of a US-China tariff war, with some economists even warning of a possible technical recession in 2025. So how should we be digesting this pessimistic outlook, and where should we be allocating our assets in the market today? We find out with Kelly Chia, the head of investment strategy at UOB Private Bank. Good morning, Kelly. How are you doing today?
Good morning. It could be better, of course, with the markets doing how they are, but life goes on.
Yep, life goes on. And lots of numbers to crunch in today for us, Kelly. So let's dive right into MTI's latest forecast for Singapore's 2025 GDP. They're expecting, the GDP for this year to come in at 0% to 2%. That represents a downgrade from the 1 to 3% range previously set in January, and a 4.4% growth back in 2024. So what are some of your biggest takeaways from the slower growth forecast from MTI this year for Singapore, and what are the possible implications it might have for investors?
Right. I mean, it's quite clear that trade tariffs are going to hit everybody hard. As a trade hub, Singapore faces a lot of headwinds, and if the total amount of value of trade is about 175% of our GDP last year. So our GDP last year about just over $500 billion. So 175, we are just under $1 trillion worth. Definitely it's going to hit us quite hard, unfortunately. We are a small exposed economy.
Yeah.
I think that also, this contraction that we are also seeing in terms of how the first quarter GDP declined actually sequentially does put a little bit of caution to many, many companies. So if you think about it, if you're a large MNC or small company or whichever size you are, all these noises are coming in. You initially intended to expand. Now it says, let's hold it off. And when companies hold off, it does hold off investments. It does really, really impact everybody down the stream, right?
Yeah.
And of course, you see a lot of noises of job cuts, weaker wages, getting louder by the week. So I think that's definitely some concern out in the horizon here.
Yeah, certainly. And I think this uncertainty is definitely putting a lot of investors on the edge. So in a ministerial statement on U.S. tariffs on April 8th, Prime Minister and Minister for Finance Lawrence Wong had said that Singapore may or may not go into a recession this year, but our growth will definitely be significantly impacted. According to JP Morgan as well, aggressive tariff policy could push the U.S. and possibly the global economy into a recession this year. They're pricing in the probability of a recession at 60%. So what could that mean for us here in Singapore then?
I guess if the world goes into recession or if the US goes into recession, no one's going to really be spared. Hopefully we sort of like tide over this a little bit better. Number one, MAS has already tried. It's easing its policy by making our currency a little bit cheaper. So our exports are a little bit cheaper, so it's a bit more competitive. But, like I said, we are a small, exposed, trade-oriented economy, so I think that's something which we need to pay attention to.
Right.
Global uncertainties will definitely hit us, whether we like it or not.
All right. Thanks for that, Kelly. Now, let's move on over to current asset allocation and the strategies that we should employ, because market watchers believe that there remains some opportunity in building additional diversification into portfolios and staying nimble to take advantage of price dislocation. So can you tell us, what is your current asset allocation to markets, where you're seeing opportunities, and some of the key metrics that you will be paying attention to?
All right. So we downgraded equities to neutral last week.
Okay.
We're not outright bearish. And we moved that, downgrade into money markets simply because of how it's turning out in terms of, the uncertainty in which we have. For equities, we would really avoid trade-sensitive firms And, we will consider a bit more defensive sectors like domestically oriented firms. If you're invested in Singapore, well, it's generally, REITs, utilities, healthcare. If you're a Singapore-based investor, which I would think most of our listeners are, I think, having a weaker Singapore dollar with what the MES is doing may not do much for us, simply because you're Singapore dollar based. But if like most Singaporeans, you love to go overseas and go for holidays, then your purchasing power might reduce a little bit. We also like fixed income, meaning that we have always maintained our position in fixed income. Bonds, especially investment grade, continue to be better.
Right.
We would avoid high yield now, simply because high yield means they could have a bit more difficulties in getting financing when times get tough. We've always liked gold from the beginning, from sometime last year. So it's basically at our price target, right, at 3,002. Also, finally, in terms of how we're going to get uncorrelated returns for some of our listeners that can get access to what I'll term the alternative space, like private assets, I think those are great for uncorrelated or much more stabilizer, a great portfolio stabilizer for investors.
All right. Okay, wow, that's a very comprehensive outlook as to how we should be, allocating our assets to the markets. Thanks for that, Kelly. Now, let's talk a little bit more about fixed income, because you briefly mentioned about that. And we've seen how the U.S. government bonds rebounded from a 5-day sell-off that last week sent 10-year yields surging by the most in over 2 decades. So what are your thoughts on fixed income in weathering the storm that we're seeing today?
Yep, thanks for that question, Dan. We've like I said just now, fixed income remains a sort of like a portfolio stabilizer. Since the beginning of the year, we've been saying investors should buy fixed income for income, right? Maybe 2-3 years ago, you bought fixed income to not just for income, but for capital appreciation. But I think those days are not exactly there anymore. Like I said, we think that the backup in yields could stabilize from here. But I think that we continue to prefer the much more higher quality investment grade type. The high yield, we've not really liked it since the beginning of the year.
Okay.
So investors should be careful. If they see a really big number, like, something's giving you 6-7% yield, I think that can be a little bit dangerous at this point of time.
Yeah, certainly. All right, don't just be caught on by the amount of yield that they offer, of course. Now, thanks for that,
definitely.
Kelly. All right, now let's move on over to our final question for today. And the topic that we're covering is the commodities markets, which are facing significant pressure amid tariff threats. We're seeing, ICE Brent briefly broke below the $60 per barrel last week, trading at the lowest level since February of 2021, while gold, which investors sometimes sell to raise cash to offset other losses, slipped along with silver. Soybeans dropped the most since January on worries that American crops will suffer from retaliatory measures, and cotton plunged by the most with the exchange limit. So what is your outlook for commodities today?
First, we are not so positive in oil. Generally, lower global growth really does mean less demand for oil. And when that happens, oil prices there does tend to stay a little bit low. So, and also, I think oil has, if, for example, the geopolitical, in terms of how messy, other than tariffs, of course, in terms of the Middle East and Russia, Ukraine, does calm down a little bit. It does take a little bit of risk off this aspect of oil. So for oil, we're not so positive. Gold, like I said, central banks will continue to buy. We view it as what I'll term out of system asset, meaning that, it's easy for sanctions to happen on any country if your assets are denominated in US dollar and in predominantly the financial systems today that are basically US dollar denominated. But it's quite hard to sanction or, control physical gold sitting somewhere, right? It can be moved, it can be sold. So I guess for us, gold is more of a for investors getting a return of their capital rather than return on their capital, meaning that, you get your money back, right, rather than trying to get a return on your money.
All right, that's one way to look at it. And I'm seeing a lot of uptrends when it comes to gold as well. I mean, we've got analysts saying that gold is up by more than 20% so far this year. There's still a record-breaking rally for the precious metal. And central bank buying a bit to diversify reserves amid Trump's unpredictable policies. Those are also some reasons to, support gold prices for the rest of this year. Well, that's been a very, very comprehensive conversation that we had. Thank you so much for joining us today, Kelly.
All right. Thanks for having me.
All right. We've been speaking to Kelly Chia, the head of investment strategy at UOB Private Bank, talking all about how you should be allocating your assets in the market today. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.